Welcome back, everybody, to another deep dive. Today, we are tackling high probability trading by Marcel Link. You've probably heard of it, but today, we're going deeper, okay? We're going to find those nuggets that can really shift your entire trading game.
Yeah. It's about those core principles that apply to you whether you've been trading for 20 years or you're just getting started.
Exactly. And, Link doesn't really sugarcoat it. He comes right out and says most people approach trading with this, like, lottery ticket mentality, expecting to get rich quick. What are your thoughts on that?
Trading is a skill. It takes time to develop it, just like any other profession. You wouldn't expect to walk into an operating room and perform surgery. You need to develop your skills.
He uses this analogy of paying tuition in your early years of trading. You're going to make mistakes. You're probably going to lose money. And he even goes so far as to say he lost $75,000 over 7 years before he found any consistency.
Yeah, that's real. He shares his own struggles, which makes his advice even more credible.
Absolutely. And he doesn't just stop there. He ties this directly to your financial preparedness. Are you financially ready to trade? Do you have enough capital? And he stresses having enough not just for trading, but for your living expenses as well.
Yeah, that's scared money. If
Yeah.
you're trading with money that you need to pay your bills, it's going to cloud your judgment.
No, so really step one is making sure that you're financially prepared to weather those inevitable losses. Would you say most traders underestimate this?
I think it's probably the biggest hurdle.
Interesting. Now, Link also talks about setting realistic goals. He says aiming for those crazy returns, like 10,000%, that it's just setting yourself up for failure.
Absolutely. Most people aren't going to make 10,000%. He encourages focusing on the process and mastering your skills instead of, swinging for the fences every time.
It's like that person who's always chasing the next hot stock tip, hoping to get rich quick. But it's really about consistency.
Right. And he also says that having a larger account doesn't make you a better trader.
So it's not about the size of your account. It's really the quality of your decisions that matter. But how do we as individual traders level the playing field with these institutions, with their algorithms and their massive resources? What does Link say about that?
Well, he is a huge advocate for leveraging the internet and all the tools that are available to us today. The charting software, real-time data, that kind of stuff.
What platforms does he specifically recommend?
He mentions TradeStation quite a bit.
Interesting. I've had good things. But here's something I found interesting. Even with all this advanced technology, he still recommends using paper charting. Isn't that a little old school?
It might seem that way at first, but he believes there's something about physically drawing the charts that creates a different kind of awareness.
It's like the difference between reading about something and actually experiencing it firsthand. Now let's talk news. Link cautions against trading solely on headlines. Why is that?
Well, he argues that by the time you hear the news, the market has probably already priced it in.
I can see that happening. You see a stock soaring, you think, oh, I missed out.
Well, he tells this story about Ramba stock, RMBS.
Yeah.
He was watching it and it was plummeting before the news actually came out.
So the market knew before the news was public.
Yeah, sometimes information travels fast. Those big institutions often act ahead of the curve.
So trying to chase those news-driven moves can be dangerous. What else does he say about the news?
He has this rule of thumb. If bad news doesn't cause a stock to drop, it's actually often a bullish signal, and vice versa.
It's like the market's telling you already knew that.
Yeah.
Now, he also talks about the importance of using multiple time frames to get a clearer picture. Why not just stick with one chart?
Well, he argues that relying on just one time frame can give you a skewed perspective. It's like looking at a piece of a puzzle without seeing the whole picture.
Okay, so how does he recommend approaching multiple time frames?
He says use your daily and weekly charts to get that bigger picture, and then you can zoom in to your 30 or 60-minute charts for your entries and exits.
So it's like having a roadmap for the whole journey, but then you switch to a GPS when you need those turn-by-turn directions.
Exactly.
So staring at a 5-minute chart all day long is probably not the best approach.
Not if you want to see the bigger picture.
So we've got our multiple time frames. We're starting to think like the market. But even in a strong trend, there are going to be those pullbacks, those bounces. How do we avoid getting shaken out by those?
He calls that chasing the market, and he says it rarely ends well. He recommends using a combination of trend lines, moving averages, and the ADX indicator.
To help us pinpoint those better entry points and avoid buying at the very top.
Right.
Okay, now let's talk about something near and dear to my heart. Oscillators. He's a big fan. Using them to fine-tune those entries and exits. What do you think about oscillators?
They can be really valuable tools,
Yeah.
especially for taking some of that emotion out of trading.
Which ones does he specifically focus on?
He talks a lot about the stochastic oscillator and the relative strength index.
The RSI.
Yeah.
For our listeners who aren't familiar with those.
The stochastic oscillator.
Mm-hmm.
It basically measures momentum and highlights overbought and oversold conditions.
So if it's screaming overbought, even if the price is still going up, it might be time to hit the brakes.
Exactly.
Okay. And what about the RSI?
Similar concept,
Yeah.
but it focuses on the magnitude of those price changes. Link talks about looking for buying opportunities as the RSI rises from that oversold territory.
So it's not just about the level, it's the context of the movement as well.
Exactly.
But he's very clear, don't use them in isolation.
Right. Always consider the bigger market context.
Now, he also talks about range-bound markets, these channels, triangles, flags, where the price is kind of stuck between those support and resistance levels.
He calls them pressure cookers, building up energy.
Until, boom, you get that breakout.
Right. That can lead to some big moves.
But I've totally jumped the gun on breakouts before, only to see them fizzle out. How do we avoid those fake-outs?
Patience is key. Sometimes those breakouts are fake, designed to trap eager traders.
So what are we looking for to confirm a real breakout?
Increased volume, a strong close above that resistance level, and ideally confirmation from other indicators.
So it's really about building a case, not reacting to a single price bar. Now let's switch gears and talk about exits. I think this is something most traders kind of neglect. We get so focused on finding that perfect entry.
He says it's arguably even more important. Exiting properly is how you lock in profits or minimize those losses.
What are some of the stop loss types he mentions?
He talks about trailing stops, which adjust upward as a trade moves in your favor.
So you're locking in profits as you go, letting those winners run.
He also talks about volatility stops, which are based on a stock's typical price swings using standard deviation.
So your stop loss is appropriate for the volatility of that particular stock.
And he has a really interesting tip. Avoid placing stops at obvious technical levels, like round numbers or right on a trend line.
Because the market loves to test those areas, so you want to be a little further away.
Exactly.
Okay, this has given me a lot to think about with my exits. Now I have a feeling Link has one more ace up his sleeve when it comes to successful trading. Something beyond the charts, beyond the indicators. What is it?
Discipline.
Ah, yes. The holy grail of trading. You can have the best tools in the world, but if you can't control your emotions...
You're going to struggle. He tells this great story about his cat, Sophie.
Okay, I'm intrigued.
She's this amazing hunter, but she's very patient. She waits for the perfect moment to strike. She doesn't waste energy chasing every bird that flies by.
So she's selective.
Very.
And Link ties this to trading. Are we being selective? Or are we chasing every opportunity? Like a hungry, undisciplined cat.
I love that analogy.
So how do we cultivate that Sophie-level discipline?
Well, he compares traders to
Yep.
professional card players.
Okay, interesting.
He says they have these traits that we can all benefit from. Discipline, having a game plan, knowing when to fold, managing their bankroll wisely.
So it's about that strategic mindset, removing the emotion. Great points. We've covered a lot of ground. But there's so much more to unpack. We're going to delve deeper into Link's insights on developing a rock-solid trading plan and the crucial importance of backtesting.
Sounds good.
We'll be right back.
Welcome back. All right, let's jump right back into it. Marcel Link's high probability trading. You know, we left off talking about discipline, which is obviously crucial. But how do we actually put that into practice? How do we create a plan for success?
Well, that's where his concept of a trading plan comes in.
Yeah.
And he's not talking about just like a list of your favorite stocks. It's much more than that. It's like a comprehensive framework, a philosophy almost, for approaching the market with intentionality.
Yeah, he stresses that this plan needs to be created before you even think about placing a trade.
So it's like a blueprint for your trading journey.
Exactly. And I think what's really interesting is how he connects this trading plan to emotional control.
Yeah, because when you're in the heat of the moment,
Yeah.
staring at that red or green candlestick, it's easy to get swept up in the emotion of it all.
He actually suggests making your key trading decisions during non-market hours, when you can think clearly and rationally.
I like that. It's like prepping your meals for the week. You're setting yourself up for success in advance.
Exactly.
So what are some of the key elements that he says should be included in this plan? Where do we even begin?
Well, he starts with a money management plan. This is where you determine how much capital you're willing to risk, how you're going to allocate it across different trades, and what your maximum loss limits are.
It's like creating a budget for your trading.
Yeah, and he suggests setting aside a specific portion of your capital as your at-risk capital.
So this is money that you're mentally prepared to lose if things go south.
Right. This is not your emergency fund. This is not your retirement savings. This is money that is specifically dedicated to trading.
And he recommends dividing that at-risk capital in half.
So if you lose one chunk,
Yeah.
you still have the other half to continue trading, giving you a second chance.
Okay, so it's like having a safety net within a safety net.
Exactly.
Now this is where it gets interesting. He says the amount you risk on each individual trade shouldn't be based on how much you can afford to lose, but rather on your trading plan and those specific risk parameters that you've set for yourself.
Yeah, it's not about saying, well, I can afford to lose the $1,000, so I'm going to throw that into this trade. It's about being much more strategic.
Okay, so how do we determine that risk amount?
He introduces this concept called fixed fraction money management.
Okay, break that down for me.
So you risk a predetermined percentage of your capital on each trade, typically 5% or less.
So if you have a $10,000 account, you wouldn't risk more than $500 on a single trade,
Right.
no matter how confident you feel.
Exactly. It's about discipline and staying in the game longer.
Makes sense. Now, what about choosing which markets to trade? Does he have any advice on that?
He suggests choosing markets that align with your trading style and risk tolerance.
Okay, so if you're a day trader,
You might be drawn to those more volatile markets,
okay.
like tech stocks or commodities,
Whereas a long-term investor, you might prefer something a little more stable.
blue chip stocks, real estate, that kind of thing.
And he cautions against spreading yourself too thin.
It's better to become an expert in a few select areas.
Now I got asked about the trading journal. This is something I've always struggled with. What specific insights does he say we should be looking for?
He challenges us to look for patterns in our decision making.
Okay, so are my winning trades based on solid analysis or just
Sure.
lucky guesses?
Exactly. And were there any emotional biases that might have influenced your decisions?
Fear, greed.
All of that.
So it's not just about documenting what happened, it's about understanding why it happened.
Right. It's about continuous learning
Yeah.
and self-improvement.
So we've got this amazing trading plan, but how do we ensure that we're actually following it when things get crazy?
Well, that's where he introduces the concept of a game plan.
Okay, so the trading plan is the overall strategy, and the game plan is how we execute that strategy.
Exactly. He suggests creating a checklist
Yeah.
of criteria that must be met before entering a trade.
So you're not just jumping into trades on a whim.
Right. And he also recommends setting your profit targets and your stop-loss levels before you enter the trade.
So you're making those decisions when you're thinking clearly, not in the heat of the moment.
Exactly.
Now, he's also a big advocate for systems and backtesting. Is that something that's relevant for all traders or just those who are really into technical analysis?
I think it's relevant for everyone. He defines a system as any set of rules
Yeah.
that you consistently apply to your trading.
So it could be as simple as buy when the price breaks above this moving average, sell when it falls below this support level.
Exactly. It takes the subjectivity out of the equation.
And then backtesting is basically testing that system on historical data.
Right. To see how it would have performed in the past.
It's also like a dress rehearsal for your system.
Yeah, you can identify the strengths and weaknesses, refine your strategies,
Yeah.
and hopefully avoid some costly mistakes.
Makes sense. What are some key things to keep in mind when backtesting?
Make sure you're using a large enough data set.
Yeah.
That includes a variety of market conditions,
So you're not just testing it during a bull market.
and then getting caught off guard when things turn bearish.
What about curve fitting?
Ah, yes. The backtesting trap. He warns against tweaking your system to perfectly fit the past data.
It's like studying for a test by only memorizing the answers.
You might ace that test, but you haven't actually learned the material.
So how do we avoid that?
Use out-of-sample data to validate your results.
Okay, so you're testing it on data that wasn't used to create the system.
Exactly.
Now, even with the best trading plan and system, discipline can still be tough. How do we stay focused when our emotions are running high?
He emphasizes the importance of taking breaks.
Stepping away from the screen, clearing your head.
Sometimes you just need to disconnect to gain some perspective.
Look.
Focus on the process, not the outcome.
So instead of obsessing over every tick, focus on executing your plan.
And stick to your rules.
And he also recommends setting realistic goals and celebrating those small wins along the way.
Yeah, it's not all about those home run trades.
It's about consistency.
Right,
Yeah.
absolutely. And don't be afraid to reach out for support. Find a mentor. Join a trading community.
Yeah, trading can be a lonely game sometimes. It's helpful to connect with others who understand what you're going through.
Definitely.
Now, I know we touched on the mental game earlier, but he really dives deep into that, doesn't he?
Oh, yeah. He argues that successful trading is just as much about mindset as it is about strategy.
It's like that athlete who has all the physical talent, but they crumble under pressure.
They need that mental fortitude.
So what are some of his tips for developing that mental edge?
He starts with self-awareness, understanding your strengths and weaknesses,
Yeah.
your biases, your emotional triggers.
Just knowing your opponent in a game of chess.
Exactly.
And he also talks about managing expectations.
Right.
Trading is a marathon, not a sprint.
You're not going to get rich quick.
And you're not going to win every trade.
We have to embrace that reality. Now, this might sound a little woo-woo, but he's a big believer in visualization. I've actually found that to be really helpful. If you can see yourself successfully executing your plan, it can actually make a difference.
And he talks about controlling that inner voice, that self-talk.
Yeah, that negative self-talk can be really destructive.
It's like having a little devil on your shoulder.
Whispering doubts and fears into your ear.
Exactly. So how do we silence that devil?
Replace those negative thoughts with positive affirmations.
Focus on your strengths, your past successes.
Build yourself up instead of tearing yourself down.
What else?
Develop a routine. That helps you stay focused, grounded, and in the right mindset.
Meditation, exercise, journal.
Whatever works for you.
It's about creating that foundation of mental and emotional well-being.
Absolutely.
Now, I think this is crucial, having a life outside of trading.
Yeah, don't let it consume you. Have hobbies, interests, relationships.
It's about balance.
Right. And remember, trading is a journey, not a destination.
It's not about reaching some arbitrary financial goal. It's about continuous learning, growth, self-improvement. Now let's talk about a common pitfall. Overtrading.
Ah, yes. The urge to constantly be in the market.
Trying to make up for losses. Or just feeling like you're not doing enough.
He describes it as a vicious cycle. That can really damage your trading.
So how do we avoid that trap?
Have a trading plan and stick to it.
Don't just jump into trades on a whim.
Set daily or weekly limits for the number of trades you'll take or the amount of capital you'll risk.
Okay, so you're putting some boundaries in place.
Right. And take breaks. Step away from the market when you need to.
Sometimes the best trade is no trade at all.
And focus on quality over quantity.
A few high probability trades are better than a bunch of random ones.
Exactly. And keep that trading journal
to help you identify those patterns that might be leading you to overtrade.
Are you more likely to overtrade after a losing streak?
Or when you're feeling stressed.
That kind of thing.
Now let's talk about two big emotions that can really mess with our trading. Greed and fear.
Ah, yes. The dynamic duo of trading sabotage?
Greed can make you hold on to winning trades for too long,
hoping for even bigger profits.
only to see them disappear.
And fear can make you sell winners too early.
Afraid of losing those profits.
So how do we manage these emotions?
Let's start with greed. Any tips for keeping that in check?
Set realistic profit targets before you enter a trade.
So you're not always chasing those elusive riches.
Right. And use trailing stops to lock in those profits.
As the trade moves in your favor.
And most importantly, stick to your plan.
Don't let greed tempt you to deviate. Now, what about fear? Any advice for taming that beast?
First, acknowledge it. Accept it as a natural part of trading.
Don't try to fight it.
Right. Trying to suppress fear usually just makes it stronger.
Okay, so how do we manage it then?
Have a solid risk management plan.
Stop loss levels, position sizing,
All of that.
so you know exactly how much you're risking.
And you can make more rational decisions,
And focus on the process,
not the outcome.
just your plan, even when it's tough.
Practice visualization.
See yourself staying calm and collected, even when the market is going crazy.
And control your self-talk.
Silence that inner critic. That's telling you you're going to fail.
Replace those negative thoughts with positive affirmations.
You got this. You've done it before.
Exactly.
Develop a routine.
That helps you manage stress and maintain a positive mindset.
Meditation, exercise, whatever works for you.
And remember, have a life outside of trading.
Don't let it consume you.
Trading is just one part of your life.
It's about balance,
Right. And remember that trading is a journey.
continuous learning,
Yeah.
growth.
Yep.
Self-improvement.
Exactly.
Now, in the final part of our deep dive, we're going to explore some of Link's more philosophical insights. We'll talk about his analogy of trading as poetry and the importance of patience, accepting losses, and embracing that continuous learning.
Sounds good.
I'm looking forward to wrapping this up.
Welcome back to our deep dive. After spending all this time with Link's book, I'm really struck by how he talks about the artistry of trading.
Oh, yeah.
He even compares it to poetry at one point.
Mm-hmm.
I remember that.
What did you think about that? At first I was a little skeptical, but it actually makes a lot of sense.
Yeah, I mean, he's saying that just like a poet. Carefully chooses each word to create a specific feeling or image. A trader has to be just as intentional.
With their actions.
Every entry, every exit, it should be done with a purpose.
So it's not just about the technicals, it's about approaching trading with this mindset of craftsmanship.
Exactly. Each trade tells a story.
I like that.
And like any good storyteller, we have to think about the plot, the characters, the pacing.
This really resonates with me because I often feel like I'm just reacting to the market instead of being more proactive.
And that's where Link's emphasis on patience comes in. He's all about waiting for those high probability setups.
Those moments when the market aligns with your strategy.
Not chasing every little opportunity.
Or trading out of boredom.
He even says sometimes the best trade is no trade at all.
Which is hard to hear sometimes.
It really is. Especially for us active traders.
Right. We want to be in the action. But he's reminding us that patience isn't passive. It's about observation. Waiting for the right moment.
Like a surfer waiting for the perfect wave.
Exactly. You don't just jump in the water and start flailing around. You wait for that wave. That suits your style.
Now, another thing that Link talks about that I think is really important is that it's okay to be wrong.
Oh, man. This is a tough one.
Especially for new traders.
We come in thinking we have to be right all the time.
But even the best traders in the world, they have losing trades.
It's part of the game.
What separates the successful traders is how they handle those losses.
They have a plan.
They manage their risks.
They don't let those losses derail their confidence.
He actually encourages us to view losses as feedback.
As opportunities to learn.
Instead of beating yourself up over a losing trade.
Analyze it. Figure out what went wrong.
And don't make the same mistake twice.
So losses aren't failures. They're data points.
I like that.
And that leads us to his final point. Continuous learning.
The market is always evolving.
We have to adapt. We have to keep learning.
Read books. Attend seminars. Talk to other traders.
There's always something new to discover.
So as we wrap up this deep dive into high probability trading, what are some of your key takeaways?
I think for me, it's that combination of technical skills and that mental game.
Yeah, you have the both.
A clear plan, discipline, risk management, and that mindset of continuous learning.
Couldn't have said it better myself.
Yeah.
So until next time, happy trading, everyone.
May your entries be precise, your exits timely, and your profits plentiful.
We'll see you on the next deep dive.
Take care.